Harsha Upadhyay, Head Equities at Kotak AMC, joins in to talk about his thoughts on the markets. Harsha, hi, morning. Are you a little bit worried now with the pace of the market? 7,100 already here. What lies ahead on May 16th? And do you think it is going to be a sell on news kind of situation that we are sort of building towards?
Well, it's very difficult to predict short-term movements. I would not like to take a call on how market is going to react on 16th. But I think post 16th, the market focus will shift towards composition of the new government in terms of who is getting what ministry, and also some of the policy initiatives that may come from the government in the run-up to the budget and also the budget. I think clearly over the next couple of months, people will start looking at news flow from the government and start positioning in sectors and stocks where there can be some upside based on that news flow and change in fundamentals. That's our view as of now.
So how much more upside, Harsha, from the current levels? We've already run up quite significantly, 7,100 levels already here. If indeed it's a strong majority win for the NDA, how much more upside do you see from these levels?
Even when we have hit a new high, we are at 7,100 or 23,500 on Sensex. Clearly, the valuations have not been much higher than the long-term averages. More or less, we are trading close to long-term averages. So clearly, even if you believe that there is unlikely to be re-rating in the markets from here on, the markets can give you returns in line with earnings growth, where we expect some momentum to build up. For the last 6 years, we have seen earnings growth CAGR of about 8%, and that's likely to move towards 15 to 16% in the next 2 years. And clearly, that's a positive that investors would love to focus on. And even if you assume no re-rating, market can move in line with earnings growth expectations.
Harsha, the driver of this rally quite clearly has been the banking pack, which has really sort of been the sleeping giant so far. And just going through your Kotak Opportunities Fund, your sectoral allocation towards banks is almost 0.25% of the fund, with names like ICICI Bank as well as HDFC and, IndusInd Bank really holding the top rungs. Do you think after the recent outperformance, you would want to juggle and shuffle your portfolio a bit, perhaps add more PSU names too?
We do have PSU banks in the portfolio. They may not be showing up in the top 10 holdings, but clearly we have an overweight even on the PSU banking space. And overall, banking has been one of the focus sectors in this fund. And we believe that there are two issues in front of PSU banks, unlike private sector banks. One is on the NPA formation, and two, on the capital requirement for further growth. We need to be selective on PSU banks. While NPA issue has been common across the sector, I think the capital requirement and ability to raise money is somewhat differentiated, and we need to look at public sector banks where there is enough capability to raise further capital for growth. I think that's going to be critical, and some of the picks that we have in the portfolio are based on that premise.
So what is it that you would recommend right now? Adding more to the private banking lot, or do you think the run-up as well in the banking space has been way too steep and there is no more scope to now make money?
As far as our portfolio strategy is concerned, I think we are going to continue with our overweight position on banking. There could be some churn within the banking sector weight depending on relative valuation and relative growth opportunities. But overall, I think we will continue to hold overweight on banking. And as of today, unlike last year, we do have a position even in PSU banks, and even there we would like to continue holding that position.
10% of your fund allocation, Harsha, is also with Infosys and TCS. Does the recent underperformance worry you, or are you adding more positions to IT?
IT has been a laggard in the last couple of months, but our position in the fund has been of an underweight compared to the benchmark. And some of the large cap IT names that you mentioned, I think they have reasonable growth ahead of them, and the valuations are not expensive. They are quoting more or less near market multiples. From that perspective, while yes, there can be some short-term underperformance because there is a clear shift that's happening from defensives into cyclicals, but overall from a year perspective, I think IT sector can still provide a reasonable upside, and that's the reason why we are maintaining those large cap IT names in our portfolio.
So should one buy on declines?
In the IT sector, or you are talking about the entire market? Yes, I think at some point of time there needs to be some more defensive bias to the portfolio. Quite clearly over the last few months, portfolio has become quite aggressive. At some point of time we may look at shifting some of those weights into defensive sectors like IT and pharma once again. But in the very short term, we are not so sure whether there is a relative upside in IT compared to some of the cyclicals. So that's the reason why we are continuing with an underweight position in IT sector.
Okay, just some other performers, and you know, Harsha, it's been interesting to see that oil and gas as well has been emerging as a leader. You guys are bullish on Reliance Industries. What to your mind is the prospect for Reliance from, say, a one-year basis, and do you think this is going to be one of the leaders of the next leg of the rally?
Without getting into stock specifics, I think clearly there are two issues that are concerning everybody who is looking at oil and gas sector today. One is on what's going to be the policy on subsidy and under recoveries from the government side, especially on the oil marketing companies, and secondly on the gas pricing issue. I think these are the two concerns which have led to some kind of underperformance of these stocks in the recent past, and we believe that with an expectation of a new government and a stable government, there can be some policy initiatives that will give clarity to some of these concerns, and if that happens, I think there is upside in the entire oil and gas sector.
Harsha, what's the view on the entire cyclical pack? I mean, of course, we've talked about oil and gas as well as banks, but that also includes the likes of industrials, which includes cement as well as, you know, we've talked about infrastructure, metals and autos as well. What's the sense that you are getting about these sectors? Where do you think there would be that green shoot which is visible right now, which could lead to significant outperformance in the near future?
Clearly, auto and cement are two sectors which are early cycle winners in any economic revival, and these are the industries where there is sufficient capacity on ground already. None of the companies are required to make fresh investments, and as and when you see a demand uptick, there can be a lot of upside on the profitability of these two industries. And more than that, I think these are the two industries where leverage has not been very high. So since we are not looking at any great moderation in interest rates, I don't think that's going to negatively impact some of these sectors like auto and cement. We believe that in a scenario where there is going to be stable interest rates and some uptick in demand, I think these two cyclical sectors can really do well. And also cement can be a play on infrastructure. While many of the infrastructure companies themselves are not in a position to show great profitability because of the stress on the balance sheets, cement sector is a cleaner way to actually play that upside going forward.